Okay, on to the third screencast, and things start to get a little bit more technical now. We're talking about what is called the money market. Alright, so we're going to be creating a graph, and the graph is going to be called the money market graph. It's going to look a lot and act a lot like the loanable funds graph that we've seen before. And this is the graph that we're going to see the Federal Reserve use to change interest rates in the economy by changing the money supply. So we're going to start with demand, we're going to add in supply, and we're going to come up with an equilibrium like we've done every other time. Now the demand for money is the combination of two reasons that people actually want to hold on to money. The first reason is to use in transactions, to buy stuff with, to use money as a medium of exchange. We call that transactions demand. The second reason that people want money, have a demand for money, is to keep money as an asset, to use money as a store of value, to keep money in your pocket, not because you want to buy something today necessarily, but maybe you'll want to buy something tomorrow or the next day. We call that asset demand. Let's talk about transactions demand first. It varies directly with nominal GDP, and it's independent of the interest rate. In other words, we need a certain amount of money to buy the goods and services that we want to buy, and whatever that amount of money is, we call transactions demand. It's independent of the interest rate because we're not really thinking about opportunity costs here. What we're thinking about is how much money do I need to buy the stuff that I want to buy. So let's take an example. Let's say that nominal GDP is $600 billion. There's $600 billion worth of goods and services to buy in the economy. And let's also say that every dollar gets used 6 times over the course of a year. I spend it at one place, that dollar gets spent by somebody else. We call that velocity, and we're going to come back to that idea of velocity in another unit. To figure out what transactions demand would be, we have to figure out how many dollars we need to buy that $600 billion worth of goods and services. Well, if there's $600 billion worth of stuff to buy and every dollar gets used 6 times, we're going to need $100 billion to buy all the stuff that we want to buy. That's transactions demand. So we're going to place that on a graph, and we're going to start off with a graph that looks like this. On the y-axis we have the interest rate, and on the x-axis we have quantity of money. So transactions demand would look like a vertical line. It's independent of the interest rate, and it's a certain quantity of money that we need to buy the stuff that we want, in this case $100 billion. So far so good. The second reason people want money is to hold as an asset. Now, unlike stocks and bonds, money in your pocket doesn't make you any extra money. It doesn't earn any interest, you can't gain anything on it. On the other hand, it's riskless to hold. Stocks and bonds can go down in value, but a dollar in your pocket is always going to be worth a dollar. So the asset demand varies inversely with the interest rate, because if interest rates are high, people aren't going to want to keep money in their pockets, they're going to want to keep it somewhere else. When interest rates are low, there's less opportunity cost to keeping money in your pocket. So asset demand looks like this. It's a downward sloping line, varying inversely with the interest rate. Again, at high levels of interest, people don't want to keep money in their pocket because they're losing out. And at low levels of interest, you might keep more money in your pocket. If you add asset demand to transactions demand, you get the total demand for money. And graphically, that would simply be adding those two demand curves together. If you do that, you get a demand curve that looks like this. The demand for money for all reasons, for all purposes, transactions, and to hold as an asset. Alright, so far so good. What about the supply of money? Now what we're going to see is that unlike in the loanable funds market, the supply of money is a vertical line. There's a certain quantity of money out there, and here we're talking about all money for all reasons. So if we ran around and just counted how much money there was, there'd be a certain amount. The combination of the demand for money and the supply of money is the money market graph. And this is the graph the Federal Reserve is going to use to push around specifically that money supply curve to change interest rates in the economy. Now we might take a second to compare this money market graph to the loanable funds graph that we've seen before, because they have very similar ideas behind them and they operate in very similar ways. The money market graph, the graph on the left, has a supply of money in it, and that supply is the supply from all sources. That's all the money there is in the entire economy. The demand is the demand for all reasons, to hold as an asset, to use for transactions. And so this is a shorter term graph, and the interest rate on the y-axis is really the nominal interest rate, the interest rate not adjusted for inflation. Think of this as the more inclusive graph about money. The loanable funds market graph you can think of as a subset of the money market graph. The supply of money was supplied from a specific source, people's savings. And the demand for money was for specific reasons, investment, or the demand by consumers to take out loans to buy consumer goods. And so it was a longer term type of graph with longer term type of loans, and the interest rate on the y-axis here is the real interest rate, not just the nominal rate, but the rate plus factoring in of inflation. Think of the loanable funds graph as the shorter term graph and the money market graph as the more inclusive graph. The truth is they're almost interchangeable except for how the supply curve looks, but that said, the shifts in the curves in the graphs are going to look very similar as we move forward. Alright, so let's talk about changes in the money supply. By changing the money supply, the Federal Reserve can change interest rates in the economy. If you move that supply of money curve around, equilibrium interest rate is going to change. Now this is an aside, but it does pop up on the AP exam. When interest rates change, it also has an effect on bond prices. Let's say that the money market graph looks like this, and let's say that the Federal Reserve decides to reduce the supply of money from $200 billion to $150 billion. This money supply curve would shift to the left, and in the future we'll be talking about how the Federal Reserve actually does that. But you'll notice that in the short term there's a little shortage of money. There's $50 billion that don't exist anymore. Well, the way that people react to that is by selling some things in order to make up the difference. They need to come up with that $50 billion somewhere. They could just sell their shoes, they could sell their houses. What we assume is that people sell bonds. Bonds are a typical asset that aren't money that people can turn into money relatively easily. And so as people are selling off these bonds to try to make up the difference, the little shortage of money that's just been created, those bond prices are going to start to drop. Anytime you start selling off something en masse, the price of that thing is going to fall or go down. And so here's the generalization that you need to memorize, and then if you can understand it a little bit more deeply, that's helpful, but this is what you need for the AP exam. Decreasing the money supply raises interest rates, and also has the secondary effect of decreasing bond prices. In other words, interest rates and bond prices are inversely related. As interest rates go up, bond prices go down. Now I'm going to throw a slide up here that I'm going to leave it to you to read through and see if you can work your way through to understand really why we get this inverse relationship. And if you don't understand it after having read through it, feel free to come in and I'll be happy to explain it. Now it works in the opposite direction as well. The converse is also true. When the Federal Reserve increases the money supply by shifting that supply curve over to the right, we'll see that interest rates drop. And as a result, and along with this, bond prices tend to go up. Again, interest rates and bond prices are inversely related. And if all you do is memorize that, even without fully understanding that, that's probably good enough for the AP exam. But if you fully understand it, you'll have a little bit easier time understanding how monetary policy works moving forward. All right, things are getting a little bit more technical. They're going to get more technical still, going relatively quickly. That's what the pause button's for. And again, if you have trouble with any of this stuff, come on in and I'm happy to help you out.
Damn it, this is too hard! Here's what I think of your test, Mr. Teacher!